The bond markets are flashing red and have just sent a huge signal to the markets. If you don't know what the bond market is or don't understand its significance in the global markets, this is over $100 trillion industry, so it's definitely something you cannot ignore. You may have heard of something called the yield curve, and that's one of the strongest signals to suggest an economy is heading into recession. That is when the yields on the short-term bonds are higher than the long-term bonds. Well, the bond market has just sent us a different signal, and the bond market yields have skyrocketed and is suggesting there may be higher inflation coming than the central banks anticipated. So sit back, relax, and let's dive deep in this article to see exactly what the bond market is telling us and what we can expect in the future. And if this video brings you value, please hit that like button for the whole YouTube algorithm. It really helps out the channel a lot. And comment your thoughts below. Do you think with all this money printing, maybe the central banks that want inflation of around 2 to 3% are going to get much higher inflation in the near future? And subscribe for latest property market and economic news here in Australia. Okay, so bond markets flash red as yields surge. Bond markets are flashing red, triggering a sharp rise in yields on growing fears that inflation could come roaring back and catch central banks by surprise, escalating to rapid rises in interest rates that the world is ill prepared for. Wow, guys, this is something that's definitely pretty shocking, and it's definitely pretty worrying, because I think we all know the reason why the markets are booming at the moment is because of the cheap credit and the cheap debt. Governments, corporations, and mum and dads have been leveraging through the max to really get us out of this pandemic and this recession, and it's definitely led to a huge surge in asset prices. But even though the central banks are buying up all these bonds to try to bring the yields down so the governments can keep on borrowing cheaper and so the banks can keep borrowing cheaper and give those low rates to customers, so then they can go out and buy properties and bid up property prices, or people can go out and buy shares on margin or shares on loans. Is this going to be the thing that could trigger that double dip recession? So yields jumped on Wednesday, with Australian government 10-year bond yield climbing almost 11 basis points or 8%. So even though 11 basis points doesn't sound like a lot, that's an 8% increase to almost 1.43%. The spike following a rally in the US Treasury markets, where yields hit 1.31%, and New Zealand 10-year yields are at 1.5%. And German bonds are at 0.35%. So that's right, in Germany they actually have negative government bonds. So the government pretty much just gets paid to take on more debt. And the UK glitz reached 0.6%. So even though the central bank does have a cash rate of 0.1%, the 10-year government bonds, where the Australian government does get a lot of its funding from, is still at 1.43%. And I'm sure the RBA is going to be targeting that to bring it down lower so the government can borrow cheaper and give out more stimulus and hopefully boost the economy. The sell-off was driven by higher inflation expectations in the US. ANZ head of Australian economics David Plank said, "The market has decided that deflationary risks have subsided and markets are increasingly confident about the recovery and fiscal dynamics, and bond yields trade inversely to prices." Well, this is very interesting. During the recession, there was worry about deflation because prices were dropping left, right, front and center. Oil actually hit in the negative, and there was a lot of worries about deflation. But now the economy so far is recovering faster than they expected. People have been flushed with cash, and maybe the governments and central banks have actually overreacted to the pandemic. Maybe they've actually created too much money in the system, and there's going to be higher inflation than they thought. And this is something the bond markets are pricing in. It's really the reflation story, agreed Deputy Head of Fixed Income Stuart Deer. He pointed to improved growth, vaccine rollouts and policy support. Markets are getting a bit excited. So yes, there is a lot of optimism in the markets right now. Everyone's feeling pretty confident there's going to be a good recovery. Things are looking like they're going to recover, but we really have to see how things are going to go once all this stimulus is taken away, and then we see how strong the economy really is. The election of the Democrat Joe Biden to the US presidency and subsequent announcements of a 1.9 trillion, that's 2.5 trillion in Australian dollars, fiscal support package to support the US economy has lifted optimism as the signs of the number of cases may have peaked. So this is something huge, guys, you have to understand, because what the US does, it affects the whole world, and especially us here in Australia. They have printed 20 to 30% of all money in existence just over the past 12 months. So something you have to know, they used to record inflation by the increase of money supply, but over the years, they've managed to find ways to manipulation the CPI to make it lower, because guess what? We all know that the cost of living is rising much more than they say, where inflation is 2%. And why would be the reason that they keep downplaying inflation? Well, the reason for that is they can't afford to lift interest rates. If they came out and recorded inflation for what it really is, about 5 to 7%, well then they'd have to lift interest rates and the whole markets would come crashing down, just like what happened in 2018 when the Federal Reserve tried to lift interest rates. The markets threw a tantrum and they immediately started selling off, and the markets are pretty much holding the central banks at ransom, saying, hey, if you lift interest rates, we'll crash the markets. So investors could generally start to worry if real yields pick up along with market inflation expectations, Mr. Plank said. Real yields are essentially unchanged, but you start to see a rise in real yields that potentially has greater negative implications, he said. And what are those negative implications? It's all these defaults that could happen on all this debt that's out there in the system, because a 1% increase in interest rate could be enough to send some people over the edge. I don't think we can sustain high bond yields. I think that if yields jump too much, we would start to see growth numbers roll over. Market expectations of inflations are rising faster than real yields, agreed Steve Amelia, a strategist at GSFM. But he said that there are some straws in the wind that inflation is on the rise. He pointed to a sharp increase in commodity prices. Commodities got smashed in March, like oil, but they're slowly marching back, just like gold as well. In March, it got sold off, but now it's had a pretty strong comeback. Went up to 2,800 Australian. Now it's pulling back to around 2,400, but it's definitely much higher than it is in March. So oil prices are back at 13 months high, breaking $60 a barrel. Mr. Deere said that there may be some near-term concern about higher inflation in the US, but any such price strength would be somewhat mechanical. We had a big fall in oil prices. Once that drops out, it'll appear as if yearly rate of inflation is shooting back up. And that's true with oil prices, absolutely tanking. It was really great. Got some cheap petrol. I think it probably hit the lowest of around 70 cents here in Melbourne. It was really awesome, filling up around 70 cents. But now that oil prices are rebounding and petrol prices are rebounding, we may see an uptick in inflation, just purely because it's a bounce from the lows where oil prices were. And that's the main reason why we saw deflation, because petrol prices dropped so low. It's a long march from commodity price inflation to higher consumer prices, and said wages will need to rise substantially for anxiety levels around inflation to increase. Well, that will be something very welcome, some wage increases, but it doesn't look like there's going to be any big wage increases anytime soon. And hey, even if wages do get back up to 3%, but if inflation gets to 4-5%, you're still losing your purchasing power. Consumer prices remain subdued, although they have shown signs of life, with Australia's fourth quarter consumer prices up 0.9%, beating forecasts of a 0.7% advance. And this is why I really look at inflation as just another tax. Prices go up, you pay more tax. Your income goes up, you pay more tax. And the strategy of the government and corporations are using now is they're not trying to repay back debt, they're trying to inflate away the debt. And you may think of it like your parents. They may have a mortgage of, say, $100,000, and you think, wow, that's really low. But probably when they got that mortgage, $100,000 was a lot of money. But because inflation's gone up, it's inflated away that debt. And this is why property investors like inflation, because it inflates away their debt. And if they can borrow 2% and inflation's at 3%, they're almost getting given money to invest in property. Mr. Miller said that there was a risk that central banks, which are trying to lift inflation into target bands, will be too slow to react if inflation starts to increase in a substantial way. You push a central banker, they are all saying, we want inflation, he said. That might be more within their grasp than they realise. If they are slow to react to higher inflation, they may find that they are behind the curve and have to jack up rates very quickly, he said. Well, that's something that's definitely worrying, guys. And as we all seen, central banks are normally always behind the ball. When the economy gets too overheated, they're too slow to lift rates, or they may not lift rates at all, like what happened in 2015, 2016, 2017, when property prices were booming. The central bank didn't lift rates, they didn't move rates for almost 3 years. And then, any sign of the economy going down, they drop rates straight away. Will we get higher inflation, and will they be too slow to act? And all these people that are getting leveraged up now because it's, they're saying, hey, money printing, cheap money, take as much as you can. Will they all of a sudden get caught when the central bank has no choice but to lift interest rates? So markets will start to anticipate such an area well before it takes place. And that's exactly right. The bond markets and the stock market, they always see what's going to come in the future, and they try to price what's going to happen in the future in advance. So they may start to price it in 6 months before it actually happens. And that's something you'll have to be aware of. So what do I think? Do I think inflation's going to, there's going to be hyperinflation, and, things are going crazy, and interest rates are going to go up to 5-10%, and there's going to be mass defaults? I do think that's unlikely. I do think it is concerning with all the money printing they're having. We have seen really, I guess you could say, hyperinflation asset prices. Asset prices and commodity prices are going up, but we're not really seeing that as much in consumer prices. But it's just something that, you should be aware of. Don't just go out there and leverage up because interest rates are low now. I can't see them really lifting interest rates anytime soon, just because the economy can't really afford it right now. And we are getting a lot of central banks saying that they would rather a little higher inflation than lifting interest rates. But guys, that's just my guess. What do you think? Do you think hyperinflation is coming, or high inflation is coming and the central banks are going to have to lift interest rates? Let me know. For all my loyal viewers and subscribers still watching, you're awesome. And if you haven't already, hit that like and subscribe button. I'll keep you all up to date on the latest property market and economic news here in Australia and globally. And of course, I'll see you all in the next video.